My name is Carl Taylor. So really, this is technically the second budget the Chancellor has announced in the past 8 months. But there has actually been a series of announcements since the previous budget in March. And you could even call some of those announcements that have come out a mini budget. But we can really see from today's budget and from the announcements we've had over the past months that the Chancellor is continuing to try and strike this balance between reining in the record spend in the wake of the pandemic and trying to stimulate the economic recovery at the same time as meeting the major funding pressures that are coming on public finances from the NHS and health and social care. So in this event this afternoon, we're going to highlight the key announcements from today's budget. And we're really going to focus on the announcements that are really relevant to small and medium-sized businesses. So I'm going to go around the panel and they're going to give you some of the key headlines that you really need to know. So starting with Joe, what were the big announcements today on COVID support for businesses and the public finances overall?
And hello to all. Firstly, I'd just like to recap on the huge cost of the support that the government's provided in the COVID pandemic, which is in the region of £400 billion. So that's a huge amount of money, and clearly the government needs to raise extra revenues to effectively pay for that over time. In particular, I'd also like to touch on the success of the Coronavirus Job Retention Scheme, or furlough grant as we know it. As the Chancellor said when he launched it in March 2020, it's the first time in the history of the UK where the government stepped in to help pay people's wages. And the cost of that grant alone was almost £70 billion. Obviously very successful in the fact that it helped to save almost 12 million jobs and provided support to over 1.3 million businesses. In the budget today, the Chancellor confirmed that the health and social care levy of 1.25% will all go to the NHS to help fund the obviously exceptional expenditure in the NHS over the past months. It should be borne in mind that this levy is an extra cost for employers, self-employed and employees. So that's an additional 1.25% on employer national insurance, employee national insurance, class 4 self-employed national insurance, and also on dividend tax. And that's all applying from April next year. And Angus will enlarge on that later in the event. I just wanted to also say a quick word on inflation. Inflation is apparently running currently at 3.1%, and it's forecast to be 4% per year very shortly. And also for interest, the average wage increase that's been recorded is 3.5% per annum. So they're quite interesting numbers to know. So as business owners, what I got out of that was, as business owners, we need to be budgeting for that. We need to include that in our business plans. So that's inflation at 4% plus the 1.25% levy, making a total of 5.25% increase in payroll costs and an average of 4% across expenses more generally to allow for inflation. So that were the main takeaways I got from it, Carl, so far. Back to you. Thank you.
Yeah, thanks, Joe. No, I think it's an important point what you just flagged up there about, over the past years, we've been used to a very low inflation, and that is changing slightly now. And so we do need to be prepared for that and do need to act accordingly. So returning to the other tax-related announcements from the budget today, Jerry, what were the significant takeaways for you?
Yeah, so I think for the most part, certainly as far as capital gains tax is concerned, it's a case of no news is good news. So we're pleased to see the Chancellor's resisted the temptation to increase capital gains tax rates or scrap entrepreneurs relief or anything dramatic like that. However, I would say that I think it remains on the hit list of items for future budgets. So we are encouraging clients and businesses to take advantage of the reliefs that are available, because we don't think they'll be there forever. The basis period changes for partnerships and self-employed individuals was mentioned, and that's been previously announced to commence from April 2024. It's been deferred. That will only impact those who are not trading from companies. So anybody's trading from a company, this doesn't apply to you. But those that are trading from partnerships or as self-employed individuals, there will be, in many cases, it will result in a speeding up of tax payments over the next few years. And there's some different options around how that can work. So if this affects you, we would encourage you to get in touch with your accountant to discuss what your options are to keep your tax bills manageable over the next few years. You might recall in the previous budget, the concept of free ports was launched by the government, and the first free ports have now been officially announced as being Humber, Teesside and Thames, and I think that reflects the government's levelling up agenda in view of the fact that two of those regions are in the north of England. As a quick reminder, these do offer some very, very generous tax reliefs, including a 10% allowance on construction of commercial new build property, 100% first year allowance for all plant and machinery, full stamp duty relief for commercial property, full business rates relief, and also full relief from employers' national insurance for qualifying employees. That's for up to 3 years per employee on earnings up to £25,000 per annum. So some really generous tax reliefs there, and certainly something worth considering if you are in the right place to be benefiting from those. On the subject of business rates, these have been frozen for a further year, which provides welcome certainty for your 2022 budgets. And the rates holiday for retail, hospitality and leisure is being extended to June next year, with a further relief of up to 2/3 of rates relief up to the end of 2022 for those sectors only. Finally, a consultation has been announced on an online sales tax. This is effectively, I think, as a way of levelling up between the kind of struggling high street retail versus online retail, which is obviously booming. And we're conscious that a lot of you do sales online, and that's an increasing avenue for you. So this is a watch this space item in terms of what changes might be afoot here, and we'll certainly be the first to tell you if there's, as soon as we know, any changes on that score. So that's all from me for now. Carl, back to you.
Thanks, Jerry. They're all key points there you mentioned. Oh, I just had some key announcements to mention around corporation tax. So particularly around, I think, as was announced earlier on in the year, in the March budget, we'd all be clear that corporation tax rates are increasing from 19% up to 25% from April 2023 onwards. So the Chancellor just confirmed, that is happening. So from April 2023, corporation tax rates are going to be 25%. But in the meantime, there are plenty of incentives and tax reliefs for capital spend, and that I think it's important everyone knows about. The super deduction announced that the last budget has come into play earlier this year, and we're already seeing our clients benefit from that. I'm getting a 130% deduction for qualifying capital spend. It's good to see that actually happening. There are some quirks around the super deduction, particularly around those that have got holding companies. It's really quite important, make sure the capital spend actually happens in the right place to maximise the super deduction. We're finding that's quite important to get that right. But the Chancellor also announced today that the annual investment allowance limit of 1 million is going to be extended until March 2023, instead of reducing down to 200,000 as it was going to. So that's great news for businesses that are investing in plant and equipment. What it means is that businesses can get a 100% deduction against profits for any qualifying capital spend of up to £1 million per calendar year. So just as a quick reminder how that works, just say you spend £100,000 on capital, plant and equipment, that reduces your profits by £100,000, and you get a 19%, £19,000 reduction in your corporation tax bill. So there's a whole allowance of a whole £1 million per calendar year right now, and that's been extended until March 2023, which is good. It's a good relief. But the only sort of blot on the horizon to sort of be aware of is that we don't really know what's going to happen to the annual investment allowance when we get to April 2023. We may well find ourselves in a situation where the corporation tax rates increase to 25%, and that could be coupled with a reduction in the annual investment allowance, that £1 million allowance, that might reduce right down. And that could result in quite a significant tax increase, especially for capital intensive businesses. So the main message really is use the super deduction and the annual investment allowance now, while they're available, while we've got those reliefs. And then just a quick word on research and development, R&D tax reliefs. There has been consultations going on for quite a while now about reforming R&D tax reliefs. And the Chancellor announced that there are changes now coming that are going to come into effect from April 2023. So it looks like some decisions have been made and there are going to be some changes happening. But it does kind of feel like the Chancellor has only shown us the tip of the iceberg on this. What wasn't announced could actually be more significant than what was announced. So we're going to need to keep a close eye on it. All we know right now is there's going to be some extension of the scope of qualifying expenditure for R&D, covering things like data and cloud costs. And there's going to be some changes to help focus the reliefs on the R&D that's actually happening in the UK. And those changes seem reasonable enough. But then there is some fairly vague references in the background announcements that the government is going to be setting out plans to tackle abuse of and improve compliance with the R&D tax reliefs. But we know little more than that right now, but the government are expecting to announce more on that later this year. So it's just important that we keep quite a close eye on that, and we're careful and prudent about what we're doing on R&D. Need to watch out closely for those announcements. Can be significant for many small and medium-sized businesses. So finally, Angus, what were your key takeaways from today's announcements?
Yeah, well, I was looking out for changes on the personal tax aspects, which I guess the actual announcements today, there wasn't massive changes on the personal tax, but we do know there has been a big thing happening on personal tax already, which is a recent announcement of the new healthcare and social levy, as we've already mentioned. So just to recap on that, that is a new 1.25% health and social care levy that's funding extra investment into the NHS and social care. And as we've said, that this applies to both employees and employers' national insurance rates, and also the class 4, so self-employed or you're a partnership, also affecting the class 4 national insurance there. As we've said, the levy is going to take into effect from April 2022, and that's when those rates will increase by 1.25%. And it is also applying to dividend tax rates. So the rate of dividend tax is increasing by the same amount from April next year. So that actually will take the highest dividend tax rate up to 39.35%. However, generally speaking, if you are a shareholder in your own or in a private company, if your remuneration is well planned and well structured, you shouldn't be paying anywhere near that level of tax. So it's just important to ensure that you are actually achieving the optimum amounts in order to keep more of what you earn. So making sure your remuneration as a shareholder is properly structured will be more important as the tax rate increases. So I guess it also leads on to the topic of like the pressures on the spend coming out of your personal pocket or directors' loan accounts, because they're having to be funded by dividends, where we're seeing the rates of tax increase. And obviously, the more you can do in a smarter way to save the pressures on this front is going to save your tax. I guess just an example of this, some of our clients are sending their children to private schools and having to pay private school fees. Well, rather than paying those school fees out of your own pocket or directors' loan accounts, for example, we've been helping people with setting up family wellbeing trusts to help with this, and that can be really tax beneficial. So I was just really mentioning that because, you know, as the dividend tax rate increases, it is more important that we're running most tax efficiently, and we need to be looking at ways that we can do that. Then the other concept was thinking about the cash locked up in companies. We've got a lot of clients maybe that have got surplus cash that's locked up in companies, and how do we actually extract that? Obviously, we don't want to be paying higher dividend tax rates on drawing this cash out. And then we're doing quite a bit at the moment with clients on this, in making sure we're putting into place some strategies and some planning how you might be able to get hold of some of that cash and not pay huge rates of dividend tax rate. So that's just a few points to mention on the dividend tax. Just a quick word on capital gains tax. This is just a small change on residential property. So usually a person's house, their main residence, you don't have to pay any capital gains tax if you experience an uplift in the value of your house. However, if you've got multiple properties, as in multiple residential properties, you can be paying obviously capital gains tax on the sale of those, and that will depend on what income tax bracket you are in. For the last 18 months, this has had to be reported on a return and paid to HMRC within 30 days. A really short time frame from when you actually sell that property to actually paying the tax for that. And the government has just extended that to 60 days. So it just gives you more time to work out the gain and pay this across to HMRC. Just a few other points on this personal tax side of things. The Chancellor's already previously announced earlier in the year that the personal allowance will be frozen for the next 2 tax years. So there's no changes on that front. And that's currently at 12,570. The other income tax thresholds are all staying the same from April next year. Another thing they did announce today was the state pension, or the pension age, the age at which you can access your pension fund. And that is rising from 55 to 57. But that's not kicking in until 2028, so 7 years away from now. But it just is interesting thing if you work out on the maths, if you're 48, age 48 now, and you've got money tied up, money in a pension fund, you might have to wait another couple of years to actually access that. So that will impact some of our clients who do have self-managed pension funds and where they've got properties and cash in there. Dividend allowances, that's a tax-free amount of dividends you can receive each year. There's been no change on that, so that's good news. Still take advantage of that while we can. Inheritance tax, there's been no major announcements on that in this budget as far as we can see, and the same with pensions. So that's just a few points I was looking out for. As I say, I was most interested to see what was going to happen from a personal tax point of view. And I reckon some of the things like inheritance tax and pensions we could see being tackled in future budgets. But that was what I was looking out for, Carl.
Thanks, Angus. Thanks for those points, and thanks, panel, for highlighting those key areas. Hopefully that's really given everyone an outline of the key announcements from today's budget relevant to small and medium-sized businesses. These are really only our initial thoughts on the headline announcements. There's obviously a fair bit of detail behind those announcements, and there's other points too. An outline of all that will be available in our budget summary publication, which is coming around by email first thing tomorrow morning, so look out for that. We realise some of these announcements are quite complex and can actually be quite confusing, but they can have a major impact on how much tax you pay and can have quite an impact on your circumstances. So if you've got any questions at all on how any of these announcements will affect you, you can submit your question to us by email. The email address is there on the slide and is on the chat as well. Or you can also book a 15-minute call with a consultant here to talk through your question. And there's a link to that on the chat as well. There will also be a link to that to book in a 15-minute call on the follow-up email that will be coming through shortly after the event. So I'd like to thank everyone very much for joining us this afternoon. It's been great to have you on board, and we look forward to seeing you again on another event soon. Thank you.